Okay, it's 1 o'clock.
All right. Good afternoon, everyone, and thank you for joining us for the next panel, Key Performance Indicators. My name is Trevor Watson. I'm the VP of Business Development at LHPH Capital. In this session, we are going to discuss the critical metrics LHPH dealers and their lenders use to monitor the health and trajectory of an LHPH operation. The term for these key performance indicators, or KPIs, and the definition is a set of quantifiable measurements used to gauge a company's overall long-term performance. They are the metrics that specifically help determine the company's strategic, financial, and operational achievements. So we have two incredible panelists that are joining us today. Both of them have a lot of insight from two different perspectives. One from the dealer perspective, that's going to be Kevin Franks. He is the CFO of Benchmark Auto Sales. They have 3 locations out in North Carolina. And then we also have Kelly McKinney, who is our VP of Risk Mitigation here at LHPH Capital, and she was formerly with Capital One Specialty Finance Division. So as we go through this session, if you have any questions that you would like to ask the panelists, there is the questions section in the swap card platform that you can upload questions. And then at the end, I'll go through and pass along those questions to the panelists if we have enough time for them to get their responses. And if we run out of time, then please feel free to reach out to us either through the swap card platform or email me directly, and then I can pass those questions along to both Kevin and Kelly, and we'll get the answers back for you guys as we go. So to start it off, let's do some introductions, and we'll start with Kevin. Kevin, can you give us a little background as to how you got into auto finance and how you got into lease here, pay here?
Absolutely. So I started my accounting career in public accounting, like all other accountants, I think. Started out with a company called Dixon Hughes Goodman. We had a specialty group in that division called auto dealerships and auto industry related topics as a specialty niche. I was asked if I wanted to head that up out of the Asheville location for the West North Carolina region. Got really involved with it. Took on Benchmark Auto Sales as a client and helped them open their doors and grow. And at one point or another, it came time that they needed a controller, and the owner, Joe, asked if I would come do the job. So that's how I got to be with LHPH dealer. And it's a really interesting business model that I thought held a lot of growth potential. I've been shocked at the growth potential that it's held over the last 10 years. So absolutely. That's how I got into the business and how the field came to me.
Nice. And when you got into the business, how many accounts did you guys have, and how many are you guys up to at this point?
We were around, if I recall correctly, 400 or 500 accounts at that point in time. And at close of business last night, we had 1,552 out of our Asheville location only.
Wow, that's outstanding.
Put apples to
All
apples. Right. So.
Excellent. And then Kelly, can you give us a little bit of background on yourself?
Sure. So I've spent my entire career so far in commercial lending, basically in credit risk management specifically. So I started out my career in early 2000 out of my MBA lending to new car franchise dealers. So I have experience with new car floor plan facilities as well as helping new car franchise dealers construct brand new dealerships and do the CRE, the commercial real estate aspect of it. In about 2006, I was offered an opportunity within the Capital One organization to take a commercial underwriting role with our specialty finance team at Capital One. So this team specifically lent to, on a rediscount basis, so an asset-based lending basis, lend to the subprime consumer space, as well as the auto and non-auto. So our commercial clients from 2006 to about 2018 were unsecured consumer lenders, so your mom and pop on the corner unsecured type lending arrangements, extensive experience in indirect auto as well as indirect non-auto, so furniture, water filtration systems, anything that a consumer can finance, we lent into that space. We also did in that unit buy here, pay here financing. So we lent to a broad range of buy here, pay here dealers at the time. that kind of with Dodd-Frank, as Nick and Nim mentioned in the previous discussion, kind of took a little bit of a turn with the creation of the CFPB. So a lot of that was unwound at Capital One Specialty Finance Group. And so I found myself with an opportunity this past February to join Terry, Tim, as well as Trevor, yourself, in the LHPH world. So taking all of my experience in deep subprime consumer lending, asset-based type structures, but now taking it and putting it into an LHPH model has pretty much what I've brought to the table with LHPH Capital. So since February, I've been sort of streamlining all of our new customer originations, making sure they go through the proper underwriting, timely, getting them closed, as well as improving our turnaround time, as Kevin mentioned with Benchmark's growth, making sure whatever Joe or Kevin needs from an existing customer, that turnaround time has improved and we're faster to the table and more adaptive and flexible. So I've been around the subprime consumer space, asset-based lending, probably since about 2006.
Excellent. All right. So to jump in here, I'm going to start off with Kevin. So we're focused on KPIs in this conversation, and since KPIs are the quantifiable measurements that we can identify with the dealership, we're obviously talking about data. So are there any important software platforms that you use with your lease year pay year program to capture that data?
Our primary software that we use is DealPack. We like DealPack for the reasons that it is an all-inclusive program. It's your data management system for your inventory, for your customers, for your collections, for your accounting, for your service. Everything's under the same roof with that. So it prevents a lot of data entry problems with if you have multiple different platforms or softwares you're using. As a lot of us started off in the business did back in the day before we all found DealPack, you can create a lot of problems with that. Things won't ever tie out. Your accounting system's not talking to your collection system, vice versa. That's a problem. So I've seen demos of other dealer management softwares that have everything all involved. My one caveat to that is find a software platform that has everything under the same roof. Don't let them send your accounting out and only manage your inventory and your collections, or vice versa. However they break out, make sure it's all under one accounting or one software roof.
Okay. Do you guys use any additional software outside of that? Do you have a separate accounting system that you guys also leverage, or is it all underneath that space?
It is all underneath that space. They are very good about sending things out. I have a separate depreciation software system that I use because we issue GAAP financials, but we also keep the tax basis in-house. So we have separate software, but our primary.
Sure.
I know our GPS software is external, but they link up. So.
Okay. All right. So Kelly, from your perspective,
Sure.
When it comes to software platforms, when a dealer is seeking funding with us or with any lender for that matter, what kind of key reports and what kind of key data are you looking for from the software?
Sure. So the most important reports are more of the collateral management that Kevin just mentioned. So when you're making sure that your collections is in line or that your collection team's working, I want to see aging files. Not only contractual, but let me see some recency, because in the environment we're currently facing, a lot of clients might be on payment plans. So if they're recent on payments, that's important from a repayment standpoint, because you have cash coming in as a dealer that can repay your loan with LHPH. So aging files are very important. Lot inventory files are important. Do you have enough inventory to sustain the number of vehicles you're putting out each month? What does your ACVs look like in that inventory report, so that we as a lender can adapt any kind of advance rates or any kind of lending that we're doing to where the ACVs may be headed or where they're going. I also like to see, and there's a couple of good reports out of DealPack, AutoMasters, as well as AFF, I'd like to see vehicle information. So the age, the mileage, the make, the model of the vehicle. What are the ACVs on that vehicle, as well as the lease structure? So there are different reports, as Kevin mentioned, in the systems that we're able to combine off of a VIN number or a stock number to be able to merge not only aging files, but I can see aging by an age or a mile or make of the vehicle. So we can actually stratify a little bit there. Another key report that all DMSs are a little different on is the actual static pool data. So charge-off reports that may come out. I've seen them in different forms, but if I get raw data of static pools, we're able as a team to analyze those in our own Excels, in our own Power Queries, and Power BI, in our own software. I can start building curves out and see where the static pools have been and where the current kind of portfolio is looking. So overall, a lot of the stuff that we're looking from the DMSs is just an overview of where those, what's the performance, not only of the consumer, because that's who's making the payments to Kevin and to Joe and Nick and them, but also what do those vehicles look like? Because that ultimately is what you're hoping to be able to leverage long term to be able to release.
Excellent. That's great information. So we established what we need in order to be able to capture those KPIs. So Kevin, let's chat a little bit about what the daily KPIs that you're looking at on just a daily basis, those real, the most important ones, I guess, the ones that you're really keeping an eye on.
So Trevor, we just send out a nightly report every night to the management team that has all the KPIs that we really find overly important. It's got your total leases out for the day, your gross on those leases, out of the street on those leases. It's got your receivable that's been created via those leases, the payment stream that's coming in off of those leases. It's got the same thing for wholesale and retail, although there's a lot less key performance on that, just kind of what's the markup on those vehicles. We then go through and have what terminated today as far as lease contracts, what was traded in on a lease contract, what got totaled out via an insurance loss, what was a true repossession, how many accounts paid off. And then we keep going down through our nightly report. We've got delinquency, and we've got delinquency broken out by what accounts are we really not ever expecting to get paid on. Like, we've started an insurance claim, but we haven't gotten it completely closed out. We've sent it out for repo, but we haven't secured it yet. All of those numbers are listed on the nightly report as well. One of the things that I would really want to stop and spend some time on is the average balance of the receivable in each of those categories. The average balance of the receivable tells you where you are in your book of business. A lower average receivable means that you're dying, in the sense of you have collected on the accounts that you've got out, but you're not putting any new accounts over the curb. So you're not growing in any form or fashion, but not only are you not growing, you're not maintaining. You're really harvesting from the tree without any expectations to fertilize that tree to grow more fruit. So that's a key performance indicator for us as well. Like I said, we do look at the gross profit and receivable generated on each lease. We also take a look at delinquency every night. And then we go through and we look at our payment streams and making sure that everything there looks like it should with the delinquency and recency. But that goes out, like I said, to our management team every night. All of those numbers are on it every night. And so it really lets us keep a good thumb on our operations.
Do you guys have anything along the lines of a weekly meeting to go through those numbers specifically, or do you?
We do have a weekly managers meeting that, as needed, we'll touch on any of those that are seemingly out of line or out of place. So, absolutely.
Okay. So those are the ones that you guys are looking at on a daily basis. Do you guys have any that you look at more on a monthly basis?
So on a monthly basis, we have some reports that come out in our financial packet to the management team that show the same type of performance indicators, but it shows the tracking history on those over the lifespan of the entire operation. So we've got some reports that go in our thing that show, hey, this is how many units we sold in October of 2016, 2017, 2018, 2019, 2020. Same thing for our leases, and we're all focused on our lease structure. What was the ACV of the car back in 2016, 17, 18, 19, 20? What was the receivable generated on that car? What was the recon? What was the finder's fees? It lets us keep not only a really close hold on what the market's doing and how the shifts of the market are impacting our business, but it also lets us see, where we've got some trends that you see the down payments went down for 2018, but they came right back up in 2019. So it lets you see those trends as well as that receivable balance that's being generated on each asset.
Awesome. Now, what about, so those seem to be much of the operational pieces. What about on the financial element? So obviously being the CFO, I suspect you have some KPIs that you're watching probably on a daily and monthly basis on the financials.
So most of those relate to cash flow and EBITDA. EBITDA is always a big one for us. We monitor that monthly. That's the banking, for lack of better reasonality there, the banker's favorite thing in the world to look at. I personally like to monitor the true value of the asset that's sitting out on the books for the balance sheet. That tells me what's actually expected to not only recycle, but there's some trends that we've been working on developing that show what cars you want to go out and lease and things of that nature. So monitoring not necessarily the book value of the asset, but the expected ability to release certain cars versus other cars. So that's one of our indicators that we're looking at pretty heavily.
Excellent. So in terms of, and we might have touched on it already to a little bit, to a certain extent, but how do you track all of these? I mean, obviously you guys have your monthly or your daily reports that go out every single night. The monthly ones, that are those compiled by you or by one of the teammates, and sent out on a monthly basis? How is that done?
So all DealPack's really nice about, they export everything that you want to export to Excel to Excel. So we send all of our raw data out to Excel. That way it can't be manipulated after the fact, and it goes into these dashboards that we've set up in Excel. Those dashboards then populate the data for the new months, new quarters. My teammates and I on the accounting team all have different reports that we build for the month-end process. But yeah, so we typically lean on Excel behind the scenes.
You guys have a very sophisticated process set up for sure. Now, if there was a dealer that didn't have all those resources yet, what would you recommend to them?
There's a lot of capacity in Excel, and getting Excel to do things for you that normal data analysis would take you 2 or 3 days. My advice there would be take an Excel class so that you can help shorten your analytics time. But as far as, everyone operates their business differently. I've learned that in this world. Everyone's key performance indicators are going to be slightly different. For myself, I'm very concerned about delinquency and monitoring that on a daily and weekly basis. Somebody else might not be concerned about delinquency, but they're very concerned about recency. So whatever those key metrics are for them, I would make sure that they are sitting there and plugging it into, some people like Word, some people like Excel, but whatever it is, if you just keep tracking that down, writing it down on a sheet of paper, and you write that number every day or every week or every month, depending on what you're doing, when you start looking at that every time you write it down, you'll start seeing your trends very quickly. And then how do you address those trends? Are those good trends? Are those bad trends? Again, it depends on what indicator you're focusing on. Like I said, for us, we focus on EBITDA because the bankers love EBITDA. In our world, EBITDA can get lost in translation with GAAP conversions LHPH thinks. There's a lot of players in there that don't really get taken into effect because they're outside of the scope of the GAAP financial from most people's operations. So when you're talking to bankers or any of that, my key piece of advice is to take your key performance indicators and explain to your banker, whoever, that this is what you're tracking and why. And it shows how, because at the end of the day, we all care about a profitable business that provides for our families. So the bank wants to make sure that you can have the money to repay. But in our world, in the LHPH world, the accounting is vastly different typically from any traditional business that the banker's seen. So there's going to be a level of education or in dealing with your third-party vendors that has to occur about how you account for things and how you monitor your business.
Yeah, I really like the idea of trending those KPIs over time. Because a KPI obviously is a snapshot, moment in time, and your idea of trending those over time, so you can actually see what is changing in the direction that you're going. That makes a whole lot of sense to me. So Kelly, let's step back a little bit. How do you think the dealer KPIs that Kevin just went over, how do those tie to a lender's underwriting process?
Sure. So there's a couple of them that I kind of wrote down that Kevin mentioned that I'll focus on. I think Kevin and I both know we could go in many directions on some of them. But I would say from a standpoint of what we look for at LHPH, and to Kevin's point, so I am your banker that you have to convince in some ways, and I've learned a lot with LHPH. But one of the things I have learned that Kevin started with is understanding the receivable balance and understanding what is new, what you're putting on new, what you're actually swapping. So in our LHPH model, if a lessor or if you take a car back, we have a swap process. So we let you keep your loan on the books, continue to amortize, but swap out the lessee that's in that vehicle on our system. And so if you're able to look at what is a brand new lessee in a brand new car that you're leasing from someone that you put into a car that's amortizing, and then looking at what you collected on your customers month to month, that's kind of a term, it's known as a roll forward. But using what Kevin said in his way, we look at what that roll forward looks like and what is that cash that's coming in from that dealership, and how does that cash transpire into that payment stream that Kevin mentioned. So we look at the loan that is made with LHPH and the payment on the lessee. How does that translate? Is it one for one? Is it there's cushion in there? Does the dealer have enough cushion such that they have operating expenses that they can pay, but still pay the LHPH loan from a repayment standpoint? The EBITDA is a big number. What I've learned over the past 10 months or so is that in the LHPH world, there's a lot of add backs to EBITDA that need to be accounted for because of operating lease accounting, that most bankers and buy here, pay here specifically, it's a capital lease. There's a reserve, there's a P&I, it's a receivable. That accounting is so much different than an LHPH model. And so there are some expenses, there is some attributes on the P&L that need to be added back to a traditional EBITDA to make it more of a cash flow that equates to a buy here, pay here, or another commercial entity. And that is a learning curve for a lot of lenders and a lot of bankers, because when you're working in a regulatory industry, the OCC tells you what EBITDA is, and that's EBITDA. And you can't convince, a regulator that there's anything different to that. So the fun part about us and what we're able to do with Kevin and other clients is I can format those KPIs. I can actually do some add backs and make it so that they're comparable. But the key to it is also trending that number. So looking at the trend, looking at what it was in 16 and 17 or 18, and then seeing where they were in 19. Now, I know COVID and everything for 2020 kind of got to look at it and say, okay, is this an anomaly? How did the businesses adapt? But the key that Kevin mentioned is being able to trend it in your reports. Delinquency. Kevin mentioned delinquency. He's looking at delinquency. I'm looking at it as well, because what I'm looking at is when a customer is not paying at that 60-day mark, our loan agreement and our structure requires that dealer to pay that vehicle off with us. And so I'm monitoring that to say, okay, how much liquidity does the dealer have? How much cash does Kevin have or Joe have or Nick to be able to pay those vehicles off because the consumer is past due? So those numbers transpire into what we look at as well from that dealer standpoint. And when I'm looking at underwriting, whether I'm going to do an increase to a dealer or we're going to modify a structure. Another key element that I know that Kevin mentioned too is we do, as a company at LHPH, we do look at the number of vehicles put out each month. We do look at what the inventory is and is there enough inventory to sustain the growth that they're looking at. So like Kevin mentioned, if you're not growing, then you're just starting to cannibalize what you already have. And you're not harvesting that tree, as Kevin mentioned it. That's important for us because when the music stops or the company isn't growing, there's only a certain amount of cash flow to cover fixed expenses or variable expenses. And so those are just part of the key performance indicators that Kevin mentioned that translate into our underwriting at LHPH that'll get us comfortable with either a structural change in a loan agreement or assisting with a new location or growing the portfolio and just making sure that we adapt to what the dealer's seeing. So as Kevin mentioned, making sure that you're talking to your lender. We have great relationships with everyone. We're talking through, okay, this is an expense that's not recurring. Well, let's go ahead and account for that in our financial covenants. Let's account for that in what we're seeing as a trend so that we're actually providing that benefit to the dealer in their finances. So everything that Kevin mentioned, we have a little bit different way as a lender to look at it, but they're all important metrics. And as Kevin mentioned, his financial reporting package each month has so many different details in it that as we grow our business and get new dealers, I learn new things and I try to incorporate that with others. So it's really being flexible and communicating. And just to kind of leverage one more thing, Trevor. So Kevin mentioned about DealPack exporting to Excel. AFS, AutoMasters, they all export in some way, shape, or form to Excel. So if I were not as data fluent, say, as Kevin and I sound that we are here, a basic Excel course, a pivot table, could go wonders for people to be able to see and dealers to be able to see what they're doing. Just the basic Excel kind of process is a good way just to start slicing it. But one of the things I'd like to add is make sure you know what you want to slice. What are you looking to get? Because, and Kevin's given me that smile here, I can make data say what you want it to say. Okay, I can slice it and give you exactly what you want it to say. But what do you want to know is the question, not what do you want to see. What information do you want to know about your portfolio? And then go ahead and get into the data and slice it. But if you tell me, Kelly, are we doing this? I can slice it and show you exactly that you're doing what you want. But knowing what you want to see is what's important. So as Kevin mentioned, looking at that asset, the make, the model, the age, you can slice and dice it every which way, receivable balances, payment stream, everything by a specific model of a vehicle. But is that even useful or value add for you to see that? So before you just kind of jump in Excel and start slicing it, think about what you really want to see and what do you want to know about your portfolio.
Definitely. You got to know where you're going in order to get there. Are there, Kelly, are there any other processes or documents that you use in your process when you're doing underwriting on a dealer for either a new line or a line increase, anything along those lines?
Sure. So from a new dealer standpoint, I know our checklist, a lot of people on this conference are going to know our checklist is very robust. But a lot of the things is just more kind of gauging sophistication and gauging a communication level. So I like to look at credit procedures. I'm not looking at them as a compliance officer. I'm not looking at them as a CFPB standpoint. I'm just looking at, do you know what you want to do? Do you know who you want to lend to and how you want to lend to them? And where are you willing to make some exceptions? I like to see collection procedures. I like to know before I structure a new deal, do you let a consumer go 60 days past due on a lease before you even try to repossess it? Or how long does that process? And it varies by state. As Joe mentioned in the previous panel, you might have to give the consumer 10 days to get their stuff before you can do anything. Those are things I need to know as a lender, because I don't want to tie your hands behind your back in your loan agreement and then your loan to me when you can't even touch the car for 10 to 14 days. That's not a very positive or collaborative relationship. So making sure I understand your collection procedures, what you are trying to do. And like I said, I'm not opining on them from a consumer compliance standpoint. It's more just what I'd like to see and what I'd like to know. The other thing that we do ask is if you are an existing buy here, pay here or LHPH dealer, what do your leases look like? What do your loan documents look like? And from that, I'm trying to gauge a structure. How do you structure your leases? And as we heard in the first panel with Nick, Joe, and Terry, lease structure is very important, not only for the success of your business, but it's important for me to know how you structure your leases so that when we do give a term sheet or we do a commitment, I'm once again not tying your hands behind your back and saying, okay, look, we don't like that, or we're going to require this, but your structure is not conducive to that. So knowing how you structure will allow the lender in any case to be flexible in that loan and make sure that we're not doing anything that's going to hinder your business model. The only other thing that kind of comes to mind, Trevor, is also business plans or charts. A lot of dealers have multiple locations, so they have a lot of rooftops, but it's one company. Some other groups that we do business with that I've seen in my previous experience, it's separate LLCs for each individual venture. And so from a legal standpoint and a collateral perfection standpoint, having that org chart and knowing how it's all going to flow and where the borrower is going to be is very important. One thing that in LHPH that you don't have that's in Buy-Pay is that related finance company. So when I'm looking at the financials, I'm not sitting here having to combine and consolidate and do eliminating entries to see what an LHPH dealer looks like. I don't have to go through that model. So knowing how it's all organized helps as well. From existing dealers, Trevor, just to kind of wrap that, but from existing, a lot of this stuff is just through communication. So if there's a change in collection or a change in credit, you and Tim you'll have monthly meetings with your dealers. And so we learn about changes in collection. We learn about changes in credit scoring models. We learn about those changes, and we're able to go back and you pass that information to me, and I go back to loan agreements and say, okay, does that work in our current loan agreement structure? Do I need to get an approval to restructure it a little bit? So on an ongoing basis, I'd like, as you're talking and Tim is talking to customers, it's nice to know any changes that are made, organizational changes or business plan changes or your growth plans. We may start a new dealer out with a $750,000 or $1 million line, but they're doing really well and getting the right vehicles. If you are communicating, if the dealer is communicating with us, then I can start working on increase approvals and getting those done in advance of the money being needed. And so that's key to just that customer service experience and just in general being able to meet the needs that the dealer has and not hinder the business.
Excellent. So one of the pieces that Kevin talked about a little bit earlier was when he's looking at his financials, what KPIs he's looking at on his financials. When you're underwriting a dealer, what kind of key items are you looking at on their financials?
Sure. So if it's a new dealer, I'm looking first to see if it's operating or capital accounting. So that if it's a LHPH dealer that's been doing it, I need to know the version of the accounting first to be able to understand what am I expecting to see on the profit and loss? What am I expecting to see from a capital standpoint? And so for the most part, we have operating lease accounts. And so there's a whole different structure there. So as I mentioned and Kevin mentioned, we do look at EBITDA. In some cases, I do look at EBITDA with the rent add back, depending on who owns the real estate property the dealership's operating in. But in almost all cases, I do have add backs. There are some non-cash charges in there. So one of the additions that we do make to EBITDA is the gain or loss on that vehicle having to be put back into inventory so you can release it. That is a non-cash item that we do add back that is not in a traditional EBITDA, but it's an add back from a cash flow standpoint. Another thing that I do look at is I look at the receivables and the payables that you have to related parties or related entities, whether it's the owner or family or friends that have invested or so. We do look at that number. We look to see whether that number is growing or stuff. Where are you getting your capital in addition to LHPH, but where are you getting your capital inherent? Like, are you growing your business? Are you keeping the profits in and getting the capital structure to be, a little bit of a delevered kind of situation? How are you handling that? We also look at not only on new dealers, but we look at your debt obligations. So I'm looking at your floor plan. Who's your floor plan with? What kind of terms they are? Almost all companies got the SBA PPP loan. Okay, so right now I'm highly focused on how that loan forgiveness is going to work and how is that going to be reported by the big CPA firms and what is that going to look like? Because that is a very highly likely add back, as Kevin and I kind of have gone back on the EBITDA. You're going to have to, in some way, shape, and form, account for that money that's being forgiven. We also just look to see if there's any other lenders or creditors. Have you gotten financing from someone else, and why did you need it, or what was it for? And is there something we could have done to help with that you didn't have to go somewhere else? Obviously, cash flow. Kevin does an incredible job of giving me a cash flow statement every month. Not all dealers do that, and that's okay. I'm savvy enough that I do my own cash flow statements. My team, we do our own cash flow. So I'm actually looking at cash flow and seeing where the cash is coming in, where is it going out. It's a very simplistic cash flow. It's not a gap-based type cash flow. I'm just looking to see where the money is coming in, where it's going.
Awesome. And then what about personal financial statements? Is that something that you take a look at?
So we do. So we do look at personal financial statements on the individual guarantors, or if it's a corporate guarantor, I try to get some financials. But I'm not looking at it, again, to opine on a lifestyle or a structure, which some lenders in my past have done. So what I'm looking for is your ability to add capital to your store in a stressed period or in an environment or a situation that might warrant it. Where are you, if you are growing leaps and bounds, there's got to be some capital coming in to supplement the capital LHPH is providing from a debt standpoint. So it's more looking at what is unencumbered that you might be able to use to be able to get some equity to put into the store. From a standpoint of income statements, we do look at personal income statements of all the guarantors, and we do get them at the beginning. And I'm looking for the discretionary nature of salaries or distributions. It's not to restrict a distribution or to restrict a salary that's paid. I'm looking just to see how discretionary it might be that if a challenging situation arose, if a dealer had to forego it, is that a possibility? So I'm looking at it from that standpoint of just what capital, what liquidity is available, not from a standpoint of scrutinizing holistically their lifestyle. And I know from my new car franchise world, that was a big topic of how, dealers spent their money on their side. But we're just looking from that standpoint of we want your business to be very successful. And so if you don't have capacity to add in, or there isn't a way to not take a distribution or so, then what does that look like from your loan? And how do we help you from a loan structure account for that?
Okay. Well, that's excellent information in terms of how those KPIs roll back up to what we're looking at from our side as well. So Kevin, let me jump back to you for a minute. And have you really experienced any hurdles that you had to overcome when it comes to tracking these KPIs, identifying and tracking the KPIs over time? Maybe you have to go back 5 or 10 years to that point, but Can you explain some of those to us?
Absolutely. The one that I'm going to jump to first is we did a tax basis to GAAP basis conversion a couple years back. And all of a sudden, you're basically hitting a hard reset on all of your trends in the accounting things of the key KPIs that you're looking at, because you can get back to the right tracking numbers, but it's just like she was talking about with EBITDA having different add backs in the leasing world that are abnormal. All of a sudden, if I want to compare my apples to 2015 and 2020, I don't have the accounting that's the same for those. So I have to stop and work through those things. So whenever you make accounting changes, or when you make methodology changes, switching from an operating or a capital lease, or you make any changes in your lease structure from the standpoint of how you want you're changing your residual or any of that, you need to stop and take that into effect with your KPI trendings, because what will happen is you will suddenly skew your numbers without realizing it with your new data, but that new data is sitting there and taking an apple and comparing it to an orange. So you're not really getting a good feel for what your business is doing. Any of those changes that are made need to be reflected in your KPIs, whether that's as simple as shading them a different color so that you know, hey guys, I'm not comparing those to these anymore. If you don't have the staff or capacity in Excel to make the changes. But other hurdles are sitting there with that basic Excel class. I'll tell you, my Excel skills have grown dramatically since I left public accounting and became a controller to a CFO. Dramatically. I used to be able to sum things, and now I can do dashboards and crazy average sum ifs and all sorts of fun formulas. But that will come with time, and Google's your friend on that. Just so everyone's aware. I want Excel to do this. If you can type that into Google, it will tell you how to make it do it. But making sure that you have the data back behind the scenes. For us personally in our dealership, we have to change our data to report our gap with how we report our repairs on cars. So if I want to make sure that I have data, I have to make sure that data comes out at the time that it needs to come out. If I make changes to my data in my month-end close period, that's again going back and comparing apples to oranges. So you've got to make sure that your data set is good before you really begin trying to look at your KPIs. Those are some of the biggest hurdles I'll talk about, because they affect everybody across the market. I've had accountants in different fields as well as the auto industry field call and go, I don't understand what happened with this term. Can we talk through it? And that's the greatest thing in the world, calling your peers and talking through something you don't recognize or realize why it's going sideways on you, because somebody else that's not in the weeds like you are will be able to give you a little outside perspective. They'll be able to raise that view from that 10-foot level that you're in the weeds on to that 100,000-foot view that says, hey, did you take X, Y, and Z into account? So I would tell you that you should build your network of peers when you're trying to build out these KPIs as well, because being able to make a phone call and ask, hey, this is what's happening. This is not what I expected to happen. Any ideas on that will really help.
And Trevor, to add to Kevin for a second, one of the things that I've learned in the 10 months that I've been here so far is that each DMS calls something different. Purchase price is not purchase price on each system. So if you are calling your peers and they're on AFS or they're on AutoMasters and they say, oh yeah, that's this field, make sure that it is that field for you. Make sure that, that you're using it, because there are nuances to each of the DMSs in terms of the nomenclature and what's used. So as Kevin mentioned, the data set is important, but one of the things that I did within the first couple of weeks of joining the LHPH Capital team was I actually took an actual lease from each dealer and compared it to the extract that we get out of their system and said, okay, this is agreed upon price, this equals this in the file I'm getting. And so just making sure that you know what each item is and what's included in that number is important, as Kevin mentioned, to be able to even slice it and look at it. But if you call up here and they're on a different system, just be careful that the names may not be identical. It could be the exact same. It says purchase price on both systems, but that number is a different number off that lease agreement in the two systems. So making sure you understand what your file that you're getting, your raw data, what those columns are. And just kind of going back, just take an actual lease contract and compare it and say, okay, this is this number, that's that number, here's my term, here's my rate. Being able to do that will help you at least be able to see what you want to be able to tell from your data.
Yeah, yeah, those are both great suggestions. Since we are getting close to the end here, I was actually going to ask you guys one more question, which really is, what recommendations do you have for dealers, for LHPH dealers that may be new or maybe kind of transitioning through a growth phase? What would you recommend to them from a KPI perspective, both for monitoring, tracking, and identifying the KPIs? So I'll start with Kev.
So for someone new, I would second exactly what she was talking about. Understanding what your data actually is and where it comes from is key. If you don't understand it, what the actual field is, I mean, we all sit here and think, yeah, purchase price, it should be X. And we're used to that because we've lived in that world. And then you get somebody new and they think that their purchase price should be the sales price on the contract. And all of a sudden that making sure your data is right and that you understand what that data field is personally is key before you ever try to go to slicing and dicing any of your data. Then for someone in growth mode, I would make sure that you've sat down and actually projected your growth out, how you plan to fund it, how you plan to sustain it, how long is it going to take you to get your money out of the street on that car. With financing, how long is it going to take to get that money out of the street on that particular car? Because you're looking to redeploy that cash in a growth mode quickly. So that's all very key points. If you're doing financing on the lease, what does that payment stream look like? What's your payment stream on the back end in your net going to be? Is that enough to cover your operating expenses? So those are your key in a growth mode things to sit down and model. What's going to happen to that growth portfolio in 6 months, 12 months? At what point in time, if you're sitting down and planning on growth, do you hit your market cap and can no longer expand that dealership operation and out of that particular location anymore? Those are all key things that in a growth scenario that you have to monitor. I'll take it a step further. If you're just looking to maintain your book of business and hold where you are, how do you not cannibalize your tree? How do you maintain that, just that hold pattern where you're not really growing, but you're not dying either? That's a key thing. Unfortunately, most of us have two levers. I'm going back to an old dealer I know that always talked with his two hands and these two levers. And one's growth, so you put your growth forward and you don't pay attention to anything else. And then you pull back the growth because all of a sudden you've run yourself out of capital or growth stability or whatever it is, but you've hit a wall and you can no longer grow the way you were growing. And so all of a sudden you slam it into batten down the hatches, close all the doors, we're not doing any more business. Well, if that's the way you do business, you can survive that way, but your life's always going to be very stressful, very hectic. You're never really going to have a pattern. Your lender's going to hate you, if I'm just being totally and brutally honest about it. Your staff's going to not appreciate it because they don't ever know which gear you're heading. But whereas if you can sit there and project out and say, hey guys, we're in this growth mode. This is where we plan to kind of stop and pull back because that's where we hit our restraints. And communication, if we get back to that communication key, but actually sit down and plan it all out, have a game plan, and have a game plan for when you're battening down the hatches. How do you survive if you turn the faucet completely off today and you don't put another lease over the curb and you suddenly get to that point where your operations are solely collecting the outstanding leases? How does that play? Do you have the funds coming through the door to cover that operating expense without doing that? If not, how are you going to get there? Because no one wants to talk about the worst case scenario, but you've got to plan for it, especially in a world today where, we're all sitting here with COVID-19 and the constraints that it's put on all of us in our businesses. And it's changed a lot of things for a lot of people and how they operate. And I'll be willing to bet you a lot of the local restaurants that have closed down didn't see that coming last year. So it's not a fun scenario to model, but it's something you've got to look at.
Well, that is great information and great advice. Thank you, Kevin. And then Kelly, I'll give you 30 seconds. It's about time that we're running out. I'll give you 30 seconds. Your suggestions.
The only thing I would add to Kevin is that as you're working with lenders, whether it's us or banks or so, make sure you understand your loan agreement. Make sure you understand how the calculations are done. And if they don't work, negotiate, work with them, talk to them, as Kevin mentioned, communicate. Everything Kevin said, I echo, but I would just make sure before you sign something or you're looking at it, make sure that that lender and even us understand what you have, where your cash is going, what does it look like? That's the only thing I would add. Everything Kevin said, it was right on point with what I had.
Outstanding. All right. Well, I'd like to thank both of you so much for your time today and all the information that you provided. It was wonderful, wonderful content. And I'd like to thank everybody that joined us today. And we do have one more session coming up at the top of the hour, so please stick around for that one. We'll be diving into cash flow. Have a wonderful afternoon.
Thank you.